Gajanan. He asks, what is tracking error, and if you can illustrate it with an example, Dhiren.
Yeah, tracking error is something which, a fund is, index fund is always tracking an index. So how efficiently it is able to track, assuming that a fund, there is a Nifty fund, there is an open-end fund which tracks Nifty, and the fund goes up by, the Nifty goes up by 1%, but the fund goes up only by 90 basis point or little less than 1%, or the fund goes, Nifty goes down by 1% and the fund actually goes up or down. It is not able to perfectly replicate the performance of the index. So the difference in the return on a day-to-day basis being added up over a period of time is is the tracking error. How efficiently, because an index fund is supposed to give me no more and no less than the index, but tracking error arises out of 2-3 reasons. One is, in case of an open-end fund, the fund company gets the money on every day, and there is a cut-off time. It is generally 3:30, and coming from different modes. The fund company and it will come from a lot of small investors, a lot of large investors. Now SEBI has made it possible to ensure that units are allotted only after realizing the money. But realizing the money for use, for investment, does not necessarily mean that the money will get invested, the money will get deployed. So the fund company may get the money, issue the units to the investor, but may not be able to invest. And next day morning, when the fund company is investing the money in those constituent in the stocks, then it may not be the same price as yesterday. So yesterday's allotment has been done at yesterday's price. The other thing is that the time when the fund company buys those stocks is not the same as when it gets the money. So allotment of units happens at a different time, and purchase of those underlying stocks in the same ratio as the index happens at a different time. The second reason why there could be a tracking error is primarily the fund company gets redemptions and new purchases. Some people buy every day, some people sell every day. After aggregating, depending on the net position, the fund company will be buying those underlying stocks or selling some shares. In that situation, buying and selling may not be of a quantum which will be a round unit, because doing it with precision, that this much percentage of Reliance Industry has to be bought or sold, or the second position might be Infosys or State Bank, exactly in the same ratio. Because if the fund company on a net basis has got about 6 lakh rupees on a daily one day inflow, or 3 lakh rupees of outflow, it may not be able to perfectly replicate the place the orders or replicate the index weightings with the precise manner. The third reason why there could be a tracking error could be, which is actually not an error, because index funds do, the raw index that we see, whether it be Nifty or Sensex, which we read on, which is being popularly quoted, Sensex crossing 30,000, they are not dividend adjusted, because when you buy these shares exactly in the same ratio, you will also be getting dividends. And the dividend sometime in a poor market can well be 3.5% of the value on an annual basis. The second thing could be and in the worst of times it is 1.5 to 2%. So that is the added return that you get. But that, to my understanding, and then comes the mutual fund expenses. Of course, that is not factored as part of the tracking error. So these are 2-3 reasons which can be an impediment of a mutual fund to precisely replicate the performance of an index with their own investments, that causes tracking error. And sum total of the daily variance between the index and the fund is captured in a standard unit over a defined time period, and that is referred as tracking error.